So what really happens when the Fed drops their rate? But what does that mean for you if you're getting a mortgage? When the Fed's expected to make a change to their policy, whether that's changing their rate or some other policy tool, the actual reaction is very different from what most people think. This is because when market traders think that the Fed is planning to drop their rate in the future, they make trades now based on the expectation of that happening, so that when the Fed actually takes action, the effect has already been priced in and accounted for. This means that the impact of the Fed's changes is felt much more in advance, and the actual change only has an impact if it's really different from what was generally expected. In fact, the best interest rates in over a year were just a few days ago, right after Fed Chair Powell spoke about the possibility of a Fed rate cut in September. The market almost immediately reacted to that news, priced in the expected change on that. Rates are going to likely yo-yo around a little over the next month in anticipation of the Fed's meeting, and then stabilize after, like they've usually done. Keeping in mind that if the Fed is getting ready to ease their rate this fall, rates will likely get a little better in advance of that happening and almost certainly won't drop in line with whatever action the Fed eventually takes. You may think, after hearing this news that the Fed is expected to drop the rate later this year, that this is a sign to wait for lower rates to buy a home because you heard that when the Fed drops their rate, that means mortgage rates also go down. However, most of the time, this is completely wrong. In fact, if we look at the last 25 years, we'll see something totally different. Before COVID, the last time the Fed really dropped their rates was in 2007 when they dropped their rate by about 1% and interest rates got better by a little less than that. Then in 2008, the Fed dropped their rate by another 4%. Instead of going down, mortgage rates went back up for most of the year to around 6.5%, end of the year right around 6%. In spite of the Fed's rate having gone down by 5% over that 2-year period of time, rates only improved by a little less than 1% overall. Here's another example. In 2000, the Fed raised their rate by 1%, but rates actually went down by almost around 1.5%. Over the next 2 years, the Fed dropped their rate by another 5%, and mortgage rates went down by only about 1% overall. It's also really important to know that in general, mortgage rates change the most not after the Fed moves their rate, but in the months leading up to the rate change. To understand this, we need to look a little bit more about what the Fed really does. The Federal Reserve has two main jobs, which is to keep prices and employment stable in the US. They do this with a few different tools, one of which is the benchmark rate, which is called the Fed funds rate. This is something that as consumers we don't ever see. It's the rate that banks pay when they borrow money directly from the Fed. When the economy's booming, prices generally start to go up more than normal, like we experienced over the last few years. To counter this, the Fed increased their rate to slow down lending overall, which decreased demand for all the things people and businesses spend money on, which helped to reduce inflation. But because the Fed kept their rate higher for longer, we're now seeing more job losses and we're heading towards a recession. So now the Fed is looking to start dropping their rate to help level out the economy. When the Fed changes its Fed funds rate, that indirectly impacts the rates for mortgage loans. Mortgage rates don't follow the Fed's rate directly, rather they move up and down with treasury bonds because mortgage rates are really driven by investor demand for this type of bond. By moving their rate, the Fed rate can put pressure on the bond market and kind of move things in one direction or another, but like the examples, it doesn't go together. Like the examples, it doesn't always move together. The other tool the Fed uses is their balance sheet. During the housing recession in 2008, the Fed started doing what they called quantitative easing, which was buying trillions of dollars of mortgage-backed securities with the goal of driving down interest rates to help stabilize the housing market. Mortgage-backed securities are bundled packages of loans that are traded like a bond. Over the next several years, the Fed purchased about $8 trillion of mortgage-backed securities. They currently hold around $7 trillion of bonds and mortgage-backed securities. They're in the process of selling those off that they started doing in 2022. The purchase and now sell-off of these securities has actually had a much larger and more direct impact on mortgage rates than the Fed funds rate. And this can directly be tied to the really huge drop in interest rates during the pandemic and the massive increase in interest rates in 2022. The Fed announced earlier this year they're planning to slow the sell-off of these securities. This had an almost immediate impact on interest rates. If the Fed continues to reduce the pace of selling these assets, interest rates should at least hold near the current levels, maybe get a little better early next year. Here again, it's usually the expectation of where the Fed is going that has the most impact on mortgage rates. This means the real impact on mortgage rates is going to be felt as the news of an expected future Fed decision is released. The last thing you should know on this is that interest rates are typically pretty cyclical, meaning they go up and down between a floor and a ceiling. We've seen this pattern repeat repeated over the last couple of years, with rates hitting a floor of just under 6%, a ceiling of around 8%. This cycle generally takes between 6 and 12 months, which means if you miss one window of low rates, be patient. You'll likely have another opportunity to get a refinance or get lower rates a few months down the road. Knowing that rates are cyclical and probably going to come down a little further at some point in the future, you may be wondering what the best strategy is if you're looking to buy a home right now. And here's my suggestion. It is incredibly difficult to time the interest rate market when you're buying a home. If you wait until rates have gone down, that's going to bring a lot more buyers into the market. And with the low inventory of available homes, analysts expect that this is going to drive prices up around 8%, which is what we've seen in the past years when rates dropped. So by waiting for the lower rate, you'll probably also have to pay a lot more for the home. It's a lot easier to time the rate market when you refinance, meaning that once you own a home, you can work with your mortgage broker to keep an eye on interest rates. When they hit a low level, lock in a refinance rate to get a better payment. That way, you can buy the home at today's prices and still take advantage of tomorrow's lower interest rates.